Hi, this is Todd Ballinger, and I'm going to give you a case study today that came in from a financial advisor. It's a pretty exciting approach that he's taking to use the software to build his practice. It's got a nice couple of components to it in that it shows another way that he's not only engaging with the client, but how he's also working with two loan officers in his local market. Now, this particular advisor is kind of shy, and what that means is he doesn't want to worry about the compliance headaches of being featured out in a case study. So he's asked me just to take the case that he sent me and use it as a sort of a talking case study. So let's get right into it. What he's doing, and I'm going to take you through the process as he laid it out to me, is he is using the advanced plan feature. So he goes in and creates a new client, and I'm going to use a client he sent me, which is I've changed some of their information, M&LPV. And he's doing what he calls a liability review. So each time he has a client come in for a review, he makes sure that he inputs their information into the software using the Ask tab. So his particular approach is to use the advanced plan and go across these five tabs, but I'm going to show you the way he's doing it. So if you're a financial advisor, you can think about this. And if you're a loan officer, this is something that you could go out and use the partner referral tool to share the software with a partner and explain to them how they can work with you in the same fashion. So he goes through and creates a new client plan, and that just basically means in creating that, it takes him right to the Ask tab when he clicked that button. He goes in and sets liability review. He puts in liability review as the plan title. He doesn't assign this to a loan officer yet, but he's got his loan officers in here as referral partners, but he leaves that blank because he's not sure if or who he's going to send it to. And this particular advisor told me that he had two loan officers that he basically spread his business out back and forth. The client's in Peoria, Illinois. I just covered up their information, but you can see here September 10th, 1956. This client's 55, and they're 10 years out from retirement. They estimated their credit scores. He doesn't have to know any of this. He asked them what they thought their credit scores were. His wife's a few years younger. They have $148,000 of income, and they're in a 34% state and federal tax bracket. Now, this is their current liability makeup. He puts in their mortgage program, clicks mortgage, and then clicks the add program to edit it. They have a $265,000 property on a 30-year fix with U.S. Bank. They started out at $200,000 was their loan amount when they bought the house about 3 years ago. The interest rate they have is 6 3/4. Their current balance is $193,450. The current payment they're making is $1,297, and he puts in their taxes and their insurance. All information that he can get from the client, and they can estimate to their best of their ability. They have two autos, a GMAC at 7 1/4 and a BMW at 6 1/2, and they owe about $40,000 on those two cars. And they have one credit card that's not paid off. They've got about a $6,500 balance, and they've just been paying that off monthly, about $200 a month. Now, in the liability review, the first step here on this Ask tab for this particular client, is to go through and ask them what it is they're trying to accomplish. And he, in this particular case, they said, well, we're going to retire in about 10 years. We're 55. If possible, we'd like to have all of our debt paid off by the time we retire. So that was their goal. Whether it's right or wrong, or it's good or bad, that's not the point. The point here is to simply use the Ask tab and go through and ask all of these particular questions. Now, we have this in a paper format, so you can scribble it out on a sheet of paper, but he enters it right into the software while they're sitting at the desk. His assistant, or paraplanner, as they're often called, often will enter in as much information as she has so that when they're actually going through the stuff, he'll simply repeat, do I have your email right? Do I have your phone right? We have that you have a mortgage of about X. What's the balance now? Do you still have that car loan? Because he'll have that information from a prior conversation with the client. Now, a very important question that he likes to ask is this one here. What additional amount do you have available from savings or investments that you'd consider applying towards this refinance? He's looking at any discretionary money or extra money that's lying around that they might earmark. In this case, this particular client said, yeah, we've got about $12,000. It was in sort of an emergency fund. It's cash. It's earning no return. And we were thinking about putting that down towards our mortgage as just a lump sum payment to help buy it down. Now, right off the bat, the question would be whether or not the best place for that $12,000 is the mortgage. Because as we can look above here, we see the mortgage is at 6.75. It's tax deductible. The cars would both be a better a solution on an after-tax basis for that $12,000. And of course, the best return would be from paying down that credit card debt and something else. But what's interesting is when this advisor asked the client about what they were planning on doing, when this came up because he asked about extra money they'd apply towards the transaction, they came up with a $12,000 number. Now, their goal, and again, she's just asking the questions. How long do you think they'll be in this house? They said after they retire, they plan to stay here, so more than 30 years. How soon would you like to pay it off? They said ideally 6 to 10 years. They'd like to have it paid off by age 65. Their assets are pretty substantial, so they're in that 126 or more, that mass affluent. They have no other major purchases in the next 36 months. And they said if they were refinancing, they'd like to roll in the closing costs. So you're asking all these questions, even though what I'm going to point out to you is that this particular advisor is not looking at a refinance transaction at all. Now, what would be your primary objective? To lower payment, higher tax deduction, or would you rather have higher payment, lower tax deduction? And in this case, the client is wanting to pay principal and try to pay this thing off. And he said, would you consider yourself aggressive, moderate, or conservative from your borrowing? And he said they would consider themselves moderate. So the advisor is doing what he does best. He's staying with his core strength, which is interviewing that client, asking them questions, looking to understand what it is that they're trying to accomplish. And I want you to really pay attention because this is a feature that a lot of people don't remember, or they skipped it in the video series. So I want you to pay very close attention to what I'm about to do. Now, so far, one step, one click manage. He interviews the client, and his area that he's least comfortable with is the borrowing. It's just not something that he feels comfortable with. So he clicks the borrowing tab, and you'll notice that all of the current liabilities are here, but none of the alternatives are expanded because he doesn't do any of this for his clients. This is what he relies on his lending partner to do for him. He then simply clicks over to the Repay tab. Now, this is very important. The way the software is structured, if you don't expand any of the options on the Borrow page for any of the alternatives, we assume that there's not currently a borrowing strategy that makes sense for that client. And on the Repay tab, we compare their current liabilities and the way they're paying those liabilities today to alternative strategies for how they would repay those liabilities. In other words, the advisor is simply creating a new client. He's collecting some valuable information. He's asking them a series of questions, and he's skipping the borrow and going straight to the repay screen. He would know, generally based on interest rates, if this client might benefit from refinancing or restructuring their debt. But he's going to rely on a partner that he works with to do that for him. Meaning after he goes through this process with the client, he'll transfer this plan to one of the 2 loan officers in his local community and have them complete the borrowing section and transfer it back to him so that he can add even more value to his client. But note, any advisor could do what this advisor is doing. He's interviewing the client, skipping the borrowing part, and going right to the repay. And what he's looking to do is see if they had extra cash, or if they had a willingness to be debt-free earlier, how might they approach that? And so the first section here, because there was no borrowing, it says current liabilities, and it says this client will be debt-free in 27 years, 2 months. So the advisor slides it out to their target time frame. Why wouldn't he do 30 years? Because the client said they'd like to be debt-free in 10 years, and this particular advisor has a target after-tax savings rate for his clients of 6%. So he puts that in, and this shows the client where they would be at the end of 10 years. In other words, with their current strategy, over the next 10 years, they'll spend $355,476. They'll have paid off both the auto and the credit card. Those will be paid off in 5 years or less. And as you can see here on the current mortgage at the end of 10 years, looks like they're going to owe, and I can see the exact remaining balance here, if I want to actually look over in the in this section, they'll have 157,795 left over on that mortgage at the end of 10 years. So they're a long ways off. They'd have to write a check in 10 years for 157,795 to be debt free. Now, when I scroll down, you'll notice this is the exact same current liabilities, but I can apply different strategies for that particular client. His favorite strategy is snowball low balance first, meaning the client's cash flow doesn't change. They're going to spend the same amount. And if you're not familiar with snowballing, that's a separate conversation. Read a little bit about it. Read our paper, our strategy on snowballing, and I'll show you where that is in a minute. But he does snowball low balance first, and he'll do after-tax or pre-tax depending on the situation, but this one was after-tax. And you'll notice that the after-tax snowballing would have this client debt-free in 10 years, 10 months, right on track for their retirement. Now, what does that mean? Debt-free in 10 years, 10 months. Well, with a snowball strategy, what's happening is each debt is paid off. That cash flow that's freed up is being freed up, okay, that can then be used to repay the other debt. So what is happening is as that first lowest balance pays off, in this case it would probably be that credit card, that $200 a month goes towards the next car. Once they're paid off, you've got $600 a month that's going towards the next car. And you'll notice the curves up here, those debts are being paid off by 5 years. Here, they're all paid off in less than 4. But as those debts are paid off, that extra cash flow rolls to the next lowest balance. And once all these debts are paid off, that gets applied towards the mortgage. So what's cool about this is the client is now spending $2,368 a month. And the advisor is saying if you would continue to spend $2,368 a month as the amount you service for your debt, we can have you completely debt-free in 10 years, 10 months. So it has a quality of feeling like magic. Now, there's a concept called asset snowballing that we'll talk about in another video, but I just want to show you how this advisor is doing this with every client. So he has over 300 clients. So his goal is over the course of 12 months to do this with every single client, to interview them, skip the borrow tab, go right to the repay tab, and see, based on their situation, what they could do to be debt-free sooner. Right off the bat, he's showing them $24,718 in savings. That's the net savings over that 10 years by snowballing that debt. You'll also notice the client had $12,000 that they had available, and he's recommending that they put that in a savings account and not prepay their debt with it, and that they use that as part of something that they would help to grow their savings over time. Now, he could have that same $12,000 going towards the debt, and if I slide it over here to $12,000, what it's going to do, this all just recalculated. You'll notice the credit cards were paid off immediately because that balance was only $6,000. Then the rest of that money would be applied towards the next lowest balance, which is that auto. And you'll notice all the debts now are paid off in 3 years, and the rest of that money can be applied towards the mortgage debt. And I can see 10 years, 9 months, it's almost exactly the same. So whether that money goes in a savings account because they need some liquidity or go towards repaying, you can just slide it over and see the financial impact and all of the liabilities and their schedules. And all this stuff changed behind the scenes. The schedules change, the reports change, the debt snowball strategy that they get as part of the report, all of that just changed with something as simple as that slider. Again, I can slide it right in the middle here, put $6,000 into a savings account to give them some liquidity, and put the other towards the mortgage and the other liabilities, and you'll notice all that credit card debt has just been paid off and the rest is going towards these autos. Very simple, very cool. But what the advisor was simply doing for this client is saying, hey, if you're willing to live with your cars, both of them are new, if you can make it 10 years with those 2 cars, I can have you debt-free at retirement, and you'll have plenty of money at that point to buy new cars and fuel that lifestyle of the future. Now, if you were this client and this advisor sat down with you and said, this is something I can do for you now, help you create a strategy to be debt-free by retirement in 10 years and save an additional $24,000, about $25,000, there's nothing about this strategy that would require this advisor to say no. There's no appraisal issues. There's no qualifying issues. So what this advisor wants to be able to do with every client is create a strategy for them to repay their debt in the most efficient way possible and to save a bunch of money. He then comes over to the Present tab. And what's cool about this, again, is because nothing was selected on the Borrowing tab, there are no proposals for new debt. It's just going to show the liability repayment strategy when he creates that report for his client. So he can check all here, and it's going to create a nice report for them with AM tables and everything, showing the debts and when they pay them off. And remember that debt snowball strategy, he can click that right here. If he really wants to add value, he might also click the credit scoring and wealth and provide them a couple of different things they can read. But he's created strategies to save them significant wealth. And then what he does, follow along, he simply clicks Send Plan to a Partner and chooses which of his 2 referral partners he's going to send that plan to. Now, their job is simple. You see, he's already done. He's gone through, he's created a plan for his client that's saving them money that they're excited about without even telling them that he's also copied this plan to a close partner who is going to review that information to see if they qualify or benefit from a refinance. When that plan comes back from that partner and all of this borrow information is filled out, if they've come up with an alternative for that client that maybe consolidates or refinances this debt at a lower interest rate, he then calls the client back and says, as you know, we already have a great plan for your debt, but I talked to one of my current partners who has found that if we refinance your current mortgage to a lower interest rate, we can have you debt-free in 8.5 years with no change to your current payment. Would you like to talk to her about that and see if you'd like to benefit from the additional opportunity to refinance? Now think about how slick that is. He's been able to position himself in such a way that he's the yes guy. He's the one that's going to bring the value if there's an opportunity to save that client some money through their debt payment. Then the only way he adds the actual mortgage piece to it is if the client and his partner, or the partner, has reviewed this and said, this is a good looking situation, we can do the following. That becomes additional value that he brings to the table. And he can then come in and supplement his plan and say, so if we do that refinance that you have available, that is going to free up for you an additional $267 a month, because we're going to lower your mortgage payment, your interest rate to about 5%. So depending on how we use that, that could go towards your savings. So we put the $12,000 in savings, and we put the extra $267 a month there, and we'll have enough money in that savings account to go ahead and pay that mortgage off in 9.5 years. Notice the savings went up now by another $10,000. So not only do they have the cash savings accumulating, which we can see goes over $50,000 over that 10-year period, but the net savings on interest and stuff now grows to $36,433. So this is a really exciting strategy and a well thought out way for this advisor to touch every single client he has over the next 12 months, which was his specific goal. A great way, if you were an advisor, you could simply follow this strategy along, align yourself with a local lender or partner, and then go through and do the same process of interview, repay, and present, and then wait to see if your partner has got something extra, something else that they could do for the client. But you're always going to be delivering that good news if it's there to be delivered. If you're a loan officer, could you sit down with financial advisors and show them how simple it would be for their assistant or paraplanner, or for them to go through and do this with each client that they meet with the understanding that you would then analyze the borrowing to see if there's some additional savings that could be had. I think it's a wonderful strategy. Hope this gets you thinking, and I hope it reminds you that every single person you sit down with as a lender, financial advisor, etc., can benefit from your advice. If the appraisal comes in too low, if the credit scores are too low, if you can't get them a loan today, it's okay. Skip the borrow tab and focus your energy on the repay tab and see what you can do to help create wealth for your clients. All the best. Talk to you soon. Have a great day.